Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 6. The historic rates of return of two securities over the past 10 years are given. Calculate the covariance and correlation coefficient of the two securities. So I've given a detailed explanation on the covariance and correlations of coefficient in the previous videos. So please watch that and then watch this. So the two securities returns are given for 10 years. So we will be taking the for covariance, the return 1 minus the expected return multiplied by return 2 minus expected return. The summation of all this product of deviations divided by the number of returns will give us the covariance. So in this case it's coming up to negative 0.8 for security 1 and security 2, and standard deviation we can find with since we need a correlation coefficient with this, which is nothing but covariance of return 1 and return multiplied by return covariance of return 1 return 2 divided by standard deviation of return 1 and multiplied with the standard deviation of return 2. So anyway we need standard deviation of return 1 and standard deviation of return 2, which we can again find out here only because we have the deviation. So the square of deviations and divided by the number will give us the variance. Root of the variance will give us the standard deviation. So for security 1 the standard deviation is 4.56 and security 2 the standard deviation is 2.9, and applying in our covariance formula will give us the correlation coefficient, which is nothing but 0.0605 negative. So it is negative correlation as we have seen in the previous videos. Positive correlation signifies the linear relationship of forward movement or in the same direction movement. In case of negative it is the opposite direction. So if return 1 is moving 1% up, then return 2 is moving 1% down. It is not a perfect correlation, so it will be in the ratio or percentage of this 0.0605. Thank you.